Okay, hello everybody, and welcome to Investing with IBD for January 22nd, 2020. I'm your host, Arusha Pierce, and with me today is Ian Formigle, VP of Investments at CrowdStreet. Thanks for being here, Ian.
Oh, Arusha, it's a pleasure to be on the show today. Thanks for having me.
On today's podcast, for the first two segments, we are going to talk with Ian about CrowdStreet and the changes that are happening in the commercial real estate investing space. And then in the final segment, we will bring Mike Webster on, and we'll go over the current market and three current stocks. So, Ian, let's get into how you got into this space. This is a brand new space that's been happening for 4 or 5 years now, right? How did you end up there? It's pretty fascinating.
Yeah, so, the original vision was to democratize access to investing in commercial real estate for individuals. And so what is generally referred to on the street as crowdfunding. And so really that journey began with incorporating the company in 2012, but really then, launching our marketplace in April of 2014. And, over the course of that history now, getting to the point where today we operate the most diverse marketplace for direct equity investments in commercial real estate, literally anywhere in the world. And so what we're doing is we're transforming how people invest in commercial real estate. And we're doing it by making it accessible and efficient and transparent, and doing that all online and making it really accessible to the individual at scale for maybe like the first time ever. So it's an exciting place to be in today.
Yeah. And so this has been around for 4 to 5 years now, right? So, or a little bit longer than that.
A little bit longer, but roughly, roughly 5 years. I mean, you look back to legislation in 2013 that passed that was really the catalyst for online real estate investing to occur, and that was the Jobs Act. So passed in 2012, Title II of it went live in 2013, and that was honestly really the catalyst for platforms like CrowdStreet.
Okay. And before that, before 2012, 2013, before the Jobs Act came out, what were you doing? Walk us through your career before ending up at CrowdStreet.
Sure. So my career dates back to the mid-1990s. It's always been in investing in one way, shape, or form. It began actually as I was a derivatives trader. So I was an equity options market maker.
Wow.
So I participated in the end of the era of standing in a crowd and wearing a jacket and making two-sided markets in equity options.
That's so cool.
I did that for about 6 or 6. Yeah, it was a fun period. I guess I got to experience the end of the days. It was great to be a young single person just being in the pits and trading. It was a blast. So, the early 2000s, as that we knew, I kind of knew at that time that was coming to a close. I started to actually direct my focus on what was going to be the next thing in my career. I had come out of a real estate family, coincidentally. So I had always known the value of real estate for how you could buy it, improve it, operate it, and create wealth through it.
Yeah.
And so that became what I started to do. And so I started to actually do it individually by buying single family homes like many investors around the country. And it was after a few years of doing that led to scaling up to multifamily. And so then I began to syndicate multifamily deals for a number of years. It was that experience that led me to a number of years, then going to an institutional real estate private equity firm.
Okay.
And then creating large joint venture deals with big institutions and acquiring, $100 million assets in major cities. And then it was after a number of years of seeing, how we create value at scale through commercial real estate and understanding risk and reward there, that when CrowdStreet was getting going in 2014, they approached me for becoming their chief investment officer. So, that's my role today.
Okay. And so you have all this expertise in real estate and investing and gathering people together to buy larger buildings, which is really impressive. Now, the people who approached you at CrowdStreet, what were they doing? What are the co-founders? What were their expertise?
Sure. So the two co-founders had, a diverse skill set that then brought them together, oriented around the same mission of, getting access into individuals for commercial real estate investing. One of whom, the original founder of the company who picked it up in 2012 and then got it launched, he was a commercial real estate broker by background.
Okay.
And then previous to that, he was actually a technology executive. So he'd been on both sides. And so he was very passionate about seeing what had happened during the downturn, seeing how, too much power vested into too few hands could create bad outcomes in the financial world, and wanted to disaggregate, that control. And so he got the company going. And then at the end of 2013, he attracted then his co-founder, who was a executive in the internet software industry and had been bringing online experiences to individuals through platforms like Earthlink and another successful startup in the security space that was based in Portland, Oregon, which is where we're based. And so it was the genesis of those two coming together to get the company live. And then I was one of two key executives who then joined right after the platform went live to kind of pick it up and then make something of it. And so it was seeing the skill sets that were assembled at the table, knowing that what they were seeking was the expertise of real estate private equity, which was, since that was my background, I felt comfortable that I could be a key contributor in that arena. And so really, when you pair real estate expertise with, technology expertise, you can have the makings of a successful, real estate crowdfunding platform.
Yeah, and yet another example of how technology is disrupting all of these environments that were essentially established for hundreds of years, right? You mentioned before, there was just too much power in the hands of the few, right? Normal people wouldn't necessarily invest in commercial real estate, but now it's pretty remarkable how technology has enabled us, or enabled you guys, to provide that service.
Absolutely. I mean, the concept of syndication had been a concept and had been a practice that had been around in the United States for over 100 years and in the world for hundreds of years. I mean, you can look back into Renaissance Europe and find syndications, right? People coming together to capitalize something privately. And so, what we saw was it was a breaking of a mold. I mean, in the 1930s, so the Depression leading into the stock market collapse of 29, leading into the Depression of the 30s, you saw legislation that came out during the Depression period that set the stage for then what happened, and just saying, hey, we need to pull syndication away from people. We need to make it private and offline. And so that was what began, 70 years of consolidation. And it was literally the Jobs Act of kind of breaking a hole in that, which was then enabled to make it more accessible again. So, legislation kind of created the current paradigm leading up until 2013. Now legislation again creating the new paradigm, which is now bringing it back to the hands of people around the country.
Yeah, and that's kind of for any industry. A lot of times legislation will just turn the tables, right? And those who are quick and recognize this change and this opportunity, they're the ones, a lot of times, if they're one of those first movers, they can really capitalize. And so CrowdStreet was one of the first movers to truly capitalize on this change, right?
It was. We were lucky to be one of the handful of platforms that got out early, and it cemented, at least early on, definitely then a thought leadership position within the space.
Yeah.
And then it was continuing to build upon our own momentum, that kept us at the top of the conversation. To the point where then we've scaled now to where now we have really cemented our place, kind of as one of the few, largest players in the space. And so, but getting out early was definitely huge, because that gave us a lot of great industry press, that gave us attention, which then, attracted investors over the years.
Right. And now, speaking of the investors, what are the type of investors who can participate and be part of CrowdStreet and take advantage of some of the deals?
Yeah, so the investors on the CrowdStreet marketplace are individuals, but it's also fair to say that they are relatively high net worth individuals. Mm-hmm. And so the key criteria for participating in an investment on our marketplace is around being an accredited investor. And so, without going into too much details, it essentially means individuals who have an income of $200,000 a year or greater, jointly $300,000 or greater, or a net worth of $1 million exclusive of your personal residence. Okay. So if you can check one of those three boxes, you meet the definition of an accredited investor, and you're eligible to invest in anything that is on our marketplace.
Okay. And so now a lot of these individual investors, what's kind of the typical amount that they invest in these real estates? Because it requires a lot of money to participate, right? Or just a pool of money Correct. To get into commercial real estate, especially.
Yeah. The average investment size on our marketplace is roughly $50,000, and they're going to go. Our minimums are 25, and then certain investors will invest six figures, and even a couple at seven figures. But typically it's going to be anywhere from 50 to 100,000 on average. Okay. With a lot of people participating at 25K. And I'd say the last thing on this note is that the reason I would say first and foremost why we're seeing the traction that we are is that this type of increment of eligibility to invest in the kinds of deals that are on our marketplace, it's just something that wasn't available a decade ago.
Right.
You might have had the opportunity to meet a developer with a deal, probably in your metro, and then they were pulling together capital from a handful of individuals. But given that real estate is capital intensive, they always need to assemble millions of dollars for any given acquisition. And so that would typically mean, well, you take the deal size, you divide it by the number of individuals, and that's going to give you your, what we would say, the average ticket size. Okay. So in the past, it often looked like 250,000. Now today it looks like 25 to 50 because of the technology that we've harnessed around this space. And
do you see in the future this getting even more spread out, more of a democratized view where the amount that you need to invest, or even people don't have to necessarily be accredited investors? Do you see that eventually on the horizon?
I do. I think over time the answer will be that this this transition, which is in occurrence right now, will continue its momentum. Probably it's going to require additional legislation to take it to the next level. There has been some that has been passed so far that has brought commercial real estate to non-accredited investors. Okay. The unfortunate part about it is it's in a fund structure, so it's really only eligible for certain types. So what we would say is in the future, more accessibility through legislation probably is going to what breaks us out to the next level.
Perfect. Okay, Ian, let's take a quick break, but when we return, we'll go over some examples of properties that are on the CrowdStreet platform. So stay tuned.
Pick winning stocks with MarketSmith. Growth 250 shows you ideas with big potential. View charts packed with key data. Use pattern recognition to see action zones. MarketSmith by Investors Business Daily. Try 3 weeks for $19.95.
Ian Formigle is our guest on Investing with IBD. Okay, Ian, let's get into some more details with CrowdStreet. And I think the best way to start this segment, to make us all understand this concept better, is let's just go over a couple of examples where some of your investors can get into and participate in some of these properties.
Sure, absolutely.
So one example is Nobu, right, in DC. That was one example that when we were speaking earlier, that people love going to that restaurant. You can actually participate and invest in that restaurant that's generating yield over a time period, right?
Yeah, the Nobu deal was a great example of, I always say that, great deals have great stories attached to them.
Yeah.
And in this case, the story behind the Nobu deal, so this is the Nobu restaurant in Washington, D.C., in the heart of Georgetown. And what we saw on the West End. And what we saw in this deal was an operator who had redeveloped the entire building, had converted an office building into condominiums, luxury condominiums, and had sold those off.
Okay.
And then what had the commercial space on the ground floor had attracted Nobu to come into that location. And as we know, Nobu is a very successful international restaurant company. It's backed by Robert De Niro and the original chef Nobu. Oh, wow. And so what they saw in that deal was, hey, we have a great asset in a great location that we have somehow managed this fantastic restaurant to come in and sign a long-term lease. And yes, we could probably spin that off and sell it with the rest of everything else that was being sold in that building. But that operator wanted to keep that asset long term because it had great cash flow.
Okay.
And so they brought the asset to us and said, "Hey, what do you think? It needs, it needs a certain amount of equity. We like Nobu in the deal long term. We looked at the cash flow and saw an ability to earn, call it a 15 to 16% annualized rate of return over a long period of time, and participate in the success of Nobu." And so, it was just a great opportunity, I think, to, you can take an asset, you could put a long-term lease on it. The long-term lease can have great tenant attached to it, and that gives you great cash flow over a long period of time.
Yeah, for the individual investor, who would have ever thought that you could, participate in the cash flow that a Nobu generates from that?
Exactly.
So I mean, it is kind of mind-blowing that these opportunities are starting to appear for normal type investors. Now, on the CrowdStreet platform, what's generally the time period for the holdings there? Just give. I know that they vary, but just kind of a general.
Yep. So while holding periods can range anywhere from 2 years up to 10 years or so, the average targeted holding period is 5 years.
Okay.
And that word targeted is important because it is the expectation of the operator, but it's not guaranteed. It will end up being shorter or longer on average, but gravitating around 5 years.
And also now with real estate, and because you invested in real estate for plenty of years, there are a lot of tax benefits when you can manage it or build it right. Are there some tax benefits that people participate in when they're doing investing in properties through CrowdStreet?
Absolutely. One of the key differences in a private equity real estate holding versus something like a real estate investment trust is that you do get this benefit of the pass through of the depreciation of the asset.
Okay.
That can give you passive losses while you're actually receiving cash in your pocket. It's a tax strategy that sophisticated investors employ, and the ones on the marketplace certainly enjoy the benefits.
Okay, Ian, let's go over a second example of a property that's been on your platform.
Yeah, happy to. So I would say another deal that stands out is a deal that we did in April of 2019. And this is a ground-up development of a 160,000 square foot office building in downtown Milwaukee. When we liked this deal when it approached us, because we had an operator and a developer that was highly entrenched in Milwaukee, had great relationships across the municipality, and you could tell that they had a lot of local buy-in on this particular deal. And also what stood out to us was we had a large law firm, an 800-person law firm, that had signed up to be the anchor tenant on the deal. So about half of the building was full on day one. So that gives you a lot of confidence and also patience for filling up the other half. So, and I think the last thing was that this was an example of a deal where downtown Milwaukee is not, it's not New York and it's not San Francisco. And so it sometimes falls a little bit off the radar of the biggest institutional and global investors.
Right.
But we saw a lot of momentum in downtown Milwaukee. And what we saw was, buy-in from companies that are ready and willing to pay for a brand new Class A office development in a city that just hasn't seen a lot of it in the last 15 years. So I think that all came together and it resonated in a story that made a lot of sense to us. So we were happy to be a part of that deal. We contributed $14 million towards that deal. And the good news is now the building is going vertical. It's on time and it's on budget. And the leasing traction has been very strong. So I think when it's all said and done, we're going to feel very fortunate to be a part of that deal 2 or 3 years from now.
And so let's just the fact that Milwaukee's really growing and stuff like that. I wasn't aware of that. So you're doing due diligence on larger real estate trends that are going on. You're placing your bets on companies that or buildings that could really thrive and start attracting new investors. What is going on in Milwaukee?
Yeah. So I mean, all you have to do is look at the downtown. Look at how the Bucks Arena was redeveloped.
Yeah.
Look at the development that has occurred around it in the form of a lot of new multifamily. So in essence, what's occurring in Milwaukee right now is an urbanization trend.
Okay.
Some cities are further along in that trend, we all know that Denver and Austin and Nashville have major urbanization trends that have been well underway for a decade.
Yep.
Milwaukee doesn't have over a decade of tenure of its urbanization trend. It's got a few years. But what that tells me is when you see a lot of money being, invested in downtown, I mean, literally multi-billions of dollars, light rail coming in, new hotels being developed, now new office, you have a story of saying urbanization trend is underway.
Yeah.
And it's better to be one of the earlier movers than one of the later movers from a return standpoint.
Right. No, that's really great. Yeah, thank you. So let's go to the third example here.
Yeah. So the third example from last year that I think was just one that really, I think, epitomized kind of what crowdfunding can do in commercial real estate is it's called 100 Edgewood, and it is a 19-story office tower redevelopment in downtown Atlanta in the Central Business District. And in this case, it was brought to us by a group called Parkway, who's a major owner and operator of office properties throughout the Southeast. Their current portfolio is about $4 billion.
Okay.
And they had this asset that they brought to us and said, hey, we're buying a great property. It's currently 100% vacant. It sits in an opportunity zone. And so we're going to acquire it for about $57 a foot. We're going to invest about $200 a foot to completely remake this property into a Class A, essentially brand new building in a 1965, vintage, shell. But we're gonna deliver a Class A experience, but yet we can offer rents that are going to be a third less than the equivalent rent would be in Atlanta's Midtown, which for people who are familiar with Atlanta is kind of where it's kind of the main and main. It's where the highest rents in the city currently reside, along with a place like maybe like Buckhead. Okay. So what we saw was that this is a deal where we're seeing a trend of going back to downtown. Downtown is having great kind of revitalization of restaurants and walking districts. We're also seeing that hey, downtown has the infrastructure in place. It's got MARTA. This building was 2 blocks away from a MARTA stop. It literally had a light rail stop in front of the building. And then we were seeing food halls and things like that show up, just down the street. And so what we saw was a great opportunity to come in, work with a group that was intent on redeveloping the asset and attracting more office users to downtown, and then to deliver, fantastic returns while they're doing it, while they're making Atlanta downtown a better place.
Very cool. Now, Ian, is there where's a good place for investors to go or potential investors to go to educate themselves on this? Because it is a pretty new trend. And as you can see, I'm pretty clueless on this.
Yeah. So, we always begin by recommending that investors just simply go to our website. That's www.crowdstreet.com. There you're going to find a wealth of information on everything from kind of the nomenclature that goes into what, these terms about real estate investing, current opportunities that are available on the marketplace, previous opportunities like the ones that we just discussed that went off the marketplace, and everywhere in between. We host live webinars constantly. And so what I always recommend to investors is, we operate a marketplace, which means deals are always coming and they always will come. And the key thing is, invest when you're ready into what you're ready to invest in. And in the meanwhile, come participate in some of the education that's available. Come attend a webinar, get to know us better, get to know, real estate operators better. This is really what it's all about at the end of the day. It's just about making this online and transparent for the individual.
That's awesome. Now, I asked you this before we started recording, but I'll ask you it again, Ian. You guys thinking about going public in the near future or in a few years?
We've got a long road ahead of us still. We've got a lot to accomplish. We've been fortunate to get to where we are over the last 5 to 6 years. I think it's another 5 to 6 years before we really even have that kind of conversation internally. Right now, it's about scaling our company. The good news is the success that we've enjoyed and the capital we've been able to attract to our company gives us a great runway. And so we are just essentially heads down for the next few years, really trying to take the platform to the next level, do right by investors. And then from there, we'll begin to have, maybe other types of conversations once we get to that point in time, but nothing immediate in the future.
Okay, thanks. So software continues to eat the world, and CrowdStreet is yet another great example of how technology is disrupting and affecting the commercial real estate business. Thanks, Ian, for being on the show today.
Oh, it was my pleasure, Risha. I'm happy to do it, and as you can tell, I love talking about deals and real estate.
Coming up next, Mike Webster, head of market strategy at IBD, will join us, and we're going to talk about current markets and 3 current stocks. We'll be back. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. We are back on Investing with IBD, and for the third segment, and he's already interrupting me, and you may recognize this interruption if you're watching IBD Live, but we have Mike Webster back, head of market strategy at IBD.
I'm so shocked that you have me back.
Trust me, I'm regretting every second of it.
I mean, it was 2 weeks ago when you had not learned your lesson.
It is always fun to have you back, Mike, and I have to do this for, just podcast etiquette.
Oh.
Thanks for joining us, Mike.
I didn't want to be here. You made me.
Okay, Mike, let's get into the current market. We have a lot of content to talk about in this segment. Mike, as always, Mike is intense. Mike does his research, and he has a lot of really cool things to share. And so let's get in the current market, then we'll go into some precedents that you are looking at with this current market. Okay, so right now, the current market, it just keeps melting up.
Oh, wait. No, I was thinking of last year. No. Yeah. So, look, not a lot has changed since last time. We've just gotten, stronger and stronger. And at the, if you rewind like a month or so, I was looking at this upper channel line, and I was very concerned that we were getting to the top of it. Right. And then once we got through it, I thought we were going to back away, and we come to the lower channel line. That's how channels work, right? You have an upper and a lower. And we got to the upper, and we just kept plugging along.
And sometimes that's what happens too, right?
Right.
It breaks the upper channel line, and then might start accelerating too.
And so if you look at the angle of it, it wasn't dramatic, but it was just slightly higher. And then the lower channel line too, if you draw it, you can see that it inched up a bit.
It's kind of even getting like a little bit more tighter, narrower band that's going
but
at a sharper angle.
It's constructive, but it concerned me a bit. So what I wanted to do is just what Bill has taught us to do is when you're concerned about something or you want to know something, just go back to the history and study it, because that's where you find your answers. So what I did is I said, okay, what's unique about this time is that we've been above the 50-day for a long period of time. Right. So, I had Praveen, which is the programmer that we have access to down at IBD, great guy, does great work, and just said, okay, how many days have we been above the 50-day, and what are some other examples of this? And he was already doing some of this work anyways for Chris Kessel. So, and he was looking at the 200-day. And so I then took that data and I just went in history and looked at all the times where we had been above the 50-day for as long as we had. And that's just an old school Bill O'Neill approach to doing research. Open mind, look at it and say, okay, I was concerned. I thought we were going to do this one thing. Right. Didn't happen. Yep. So readjust, be flexible. And so we're going to go through some of those examples now, and I think they're very eye-opening. Now, on my Twitter feed, which, have you seen my Twitter feed before?
No, I haven't.
I've been known to tweet once or twice.
You have, and that's why you're here. I wanted to give you the award for the most tweets. In the shortest amount of time. You beat Kim Kardashian. Congrats.
Well, yeah, but she's cute and, I'm fat and ugly. So what are you going to do? But anyways, let's go through these and we'll do them in chronological order. Now, the reason why I brought up the Twitter feed is if you go onto mine, it's M. Webster, 1971. I've posted all of the times where we were above it for this long, but we're just going to do a select few, and these are the ones that I think look more like what we're dealing with. So if you look at the current NASDAQ, we have an arrow there for the day that it went above the 50-day.
And so you can look at it on Mike's, or you go on investors.com/podcast if you want to follow along with the video.
Exactly. It's on October 11th. So that was the day that we were above the 50-day. We gapped up. And so that's going to be the reference point for these charts that we're going to look at. So let's look at the first one. And it's the end date is October 17th, 1978. And so most of these, what I was doing is looking at the time frame from when you're above the 50-day until you were below it, and most of the time the high was below the 50-day. You can see in there's a couple days where you're underneath it. So it's more of an art form than an exact science. The computer printed out the other date, but I looked at it and said, this is part of this larger move. So the first arrow you're seeing, equate that back to October, our current October,
right.
And then where that second arrow is that's where we are in time, going into this past weekend. So roughly about 14 weeks or so, I think it was.
So 14 weeks it's been above the 50-day.
Exactly.
Okay.
So the point of this exercise is to look at it and say, everyone's saying we've gone so far, we've got to pull back, it's got to be over, it's getting euphoric, is to just look and see, do we have other examples? And here are other examples where, this is only not even halfway through this move that you had. And it didn't mean that after this that you went into bear markets. It was just, this was the sweet spot, the trending spot where you're going to make a bunch of money.
Yep.
And so that looks relatively similar to what we've got going on right now, where it was that kind of that tight uptrend. Now, this did have a decent correction pullback into the 50-day right after that arrow there.
Right.
So that's a possibility that we could have, and then just resumed.
Yeah, it took like a month off, and then it resumed its trend again.
Which would be normal. Let's go to the next one. Let's see.
And so the
which
next
one is
date.
that?
Is it
That'd be
1980?
Yeah, December 9th, 1980. So this setup was a little different than what we have now because you were coming after a correction.
Yes.
So that gives you a different type of feel, but you can see how steady that move was. If you look at the lines we have there, we have the 200-day, which is the black line, the red line, which is the 50-day, and then the 21 exponential, which is the blue one, and how tight it was. And imagine feeling kind of like I was a month ago, just going, this can't last for this long.
Right. Yeah.
But you look at history, and that's why Bill has taught us, just look at history, and you can see what's possible. And then eventually, it does crack. It can't stay above it forever. But here's another example where about halfway through the move is where we're at now.
Yeah. Yeah.
Anything you wanted to note on this one?
And with this 1980 example, this is climbing a big wall of worry.
Right?
Right? Yeah. And it just kept going. So everyone is waiting for that pullback. They missed out on this tremendous opportunity.
Well,
right?
we
so
have nothing
to
to worry about right now because, we don't have conflicts with Iran or possibly North Korea coming back up. We don't have the president, in an election year possibly being impeached.
Right.
Or we do have some problems, and we've got earnings season. So
but
the
charts in the end, the charts are going to give. It's going to tell you the feeling of the market, whether that's significant news or not.
Right.
And for right now, it just seems like it just keeps brushing it off, which is a characteristic of a good market.
Classic bull. Okay,
Right.
The next one, this one is really powerful. The 1983, July 8th, 1983 is the end date.
Wow.
And really, really powerful. So I could see something like this happening, and especially with today's action, it kind of felt like a downside reversal, ish. Some speculative stocks were getting hit, and you could see something like that happening, and it doesn't even touch the 50-day. It just resolves itself. And what would you say? This is about a third of the way?
This is a third of the way. and this one, it takes 3-4 weeks off, maybe a little bit longer. Mm-hmm. Right, so you had that one kind of really scary moment, and at that point, it's natural for a lot of us to say, "Oh, it's over. be too aggressive to the downside and just get out. And you could do that, but you want to keep in mind that you want to be flexible. And that's always been my problem. Is I'm quick to get out, but then sometimes just it's hard for me to change that bearish mentality or kind of that fear that I might have.
Well, you told me once.
Yeah.
It's not a problem anymore. I'm going to tell you it's not a problem. Be Gumby. Eddie Murphy Gumby from, Saturday Night Live. Just be Gumby. Be flexible.
I think I should be the Eddie Murphy version of Gumby.
Just be Gumby. And if you were in that situation, you start coming down, you're going, if the market's down 1%, our stocks are down 4 or 5%. Exactly. If you're on margin, that's hurting.
Exactly.
And you have to react. And so you react. And then if the market stabilizes, then you just be Gumby and just go back in.
Right. And you don't have,
and that's how Bill has always traded. Very, very flexible.
Yeah, and that's the key. And it's not like maybe get off margin, right?
Yeah.
Maybe get a little bit under 100%. It doesn't have to be go to 0%. Because then if you go to 0%, it's even harder to get back in.
Yeah.
Right. So that's so as Mike told me last year, it's not a problem anymore, which it isn't, because I've been scaling a lot more back in and out. But this 1983 example that we're looking at right now, it's amazing at how long this rally went. It was a good 9 months.
That was the beginning of the major bull market,
right?
So that was a very special one. And that was, around the Reagan tax cut time frame. Okay, so let's see what our next one is. I just got to get it.
86?
86. Okay, let me pull up 86.
So July 11th, 1986.
Yeah. So very kind of, I think everyone who's looking at these, and hopefully you're either pulling these up when you get home, if you're maybe listening. I listen to your podcast in the car on my way home. You have the most amazing podcast, by the way.
Especially when you're on, Mike.
Yes. The only problem is I can't, when I listen, I can't see you smile. And you're just like, you got the best smile. But pull these up or go on to investors.com and watch this podcast so you can see these charts. And they all have that same look and feel to them. And this is about a little bit more than a third of the way in there, but how tight it just inched up. And like you said, the wall of worry that you have. And let's do the final one.
And that was the 86 rally. Another incredible rally. Huge opportunity to do very, very well.
Right. And let's see. The last one is 1995.
October 4th. Yep.
Yeah, October 4th, 1995. And so now this is getting a little bit more recent. So you can see the moves are a little bit more dramatic. And towards the end there, you do have some wild swings. Yeah. But look at it. That's like a quarter of the way.
Yeah, and honestly, for this one, in my opinion, and I have to look at these a little bit closer, but when I look on the daily chart for this, it looks like this market went sideways for a good amount of time, kind of like what we went through. Now, we went through, like 18 months or so sideways action. Yeah. I don't know how long this one went, but it looks like it went for at least a year sideways, and then once it takes off, it just slowly crawls up, and then it slowly accelerates more and more, and then you kind of get that euphoria.
Yeah, very similar. So when you get a chance, people should pull this up on a weekly chart and look at it, relative to what we're going through. But the point of this exercise, and I call it just another Bill O'Neill exercise, is to see what's possible. Doesn't mean this is going to happen, but just like we look at model stocks, we want to see what is this potential. I mean, we could have hit the peak today and then we just crashed tomorrow, 1987 crash. But what's likely is the way we're set up, the way we've been able to brush off really significant news, is that we're more in something like this. And we've got earnings, it's going to get volatile, but so far the market is telling us we're more likely to in something like this, and we've maybe just a third of the way.
Yeah, no, this was really valuable. I mean, it's very, very helpful because it's so natural to think, okay, the move is over, but this really puts into perspective. So thank you. Let's go into a few current stocks. We have a little bit of time here, and the first stock is Costco. Okay, ticker symbol COST. Just in case.
Love this stock, right? And
we're both proud Costco members.
We're Costco members, and I'm a Costco shareholder too. You too?
Yes.
Yeah. Okay. So, looking at a monthly of this, you can see that it's had some incredible moves over the years. Now let's flip over to a weekly to kind of get that context. That this is not a high flyer. So this is nice to have in your portfolio if you're trading what we call kind of high octane heat type of stocks,
right.
Is to have a Costco in there that, on any given day, it's not up a lot or down a lot because it's just that steady type of performance. And it's the nature of the company of what it does. It's just a high margin business. They're making their money off of their membership fees.
And that's really the key, right? All their products that they sell, there's not a lot of margin on those.
They're like just
razor thin.
Razor thin.
Yeah, but it's really the membership fees. That's where they're really making the money.
What else? What other company does that?
Like Amazon.
Exactly, right? So it's kind of funny that the difference in we didn't rehearse.
I know. You put me on the spot right there.
And what is Bezos' home address? I'm just kidding. But you can see that the volatility of Amazon has slowed down these days. It's been a bit of a laggard, although it's setting up in a cup and handle right now. But so it's kind of morphed into a Costco type of thing because it's big numbers and they treat their employees so well. I was just watching on Mad Money the other day. Jim Cramer interviewed the CEO. It was a great, excellent interview, and they just treat their employees so well that how that helps is customers are happy because they're around a bunch of friendly, happy people, and their turnover employees is very low, so they don't have to train them.
It's a great model.
Yeah. So let's go to the daily to just kind of go over the nitty gritty. So it's this tiny little base. The RS line is lagging, so I'm not thrilled about that. But this is not a high octane name, and it just kind of came out of this cup without handle.
Or a flat base.
Or a flat base. Yeah, it's
Well, one or the other.
Yeah. You can look at it both ways, and the 300 level was kind of a key level. Psychologically, we like those round numbers. It goes back to the Livermore days, and you know what I'm talking about with those. Whenever a stock goes through up 100, 200, 300, and so on, it's important. It was able to go through that, stay above it, and then it had a really powerful move yesterday, which is kind of uncharacteristic of Costco.
And breaking out of that flat base on MarketSmith with the pattern recognition.
Yeah, exactly. And
the volume was pretty good too, 74% above average.
For a stock
Costco.
like this? Yeah, it's that's a massive move. So anyways, what I'm expecting from this is not a huge move, but this is that helps balance out my portfolio with some of the other stocks we're going to talk about now.
Right. There's a steady Freddy, as we call. Let's go
Steady Eddie.
Or Steady Eddie.
Yeah.
Let's go to the second stock, and that's XP.
Yeah.
So you want some high octane, you're going to get it with XP.
Yeah.
And I have shares of this.
Me too.
You have shares.
So this
less shares, right, to handle the volatility, though, too.
Yeah.
Right?
So this, kind of looks like the Google IPO. As one of the things we talked about on IBD Live a couple weeks ago. I think Justin Nielsen brought that up. And if you go back and look at the original Google IPO, you can see that it had just a short little move up. And then you came down, not undercutting the original first couple days of trading, didn't undercut the IPO price, and the depth was only 12% on Google, and it was 12% here.
Wow.
And what's also interesting is the characteristic of this stock on its up days to close mid-range is something that Google had on very early on too.
That's really interesting.
Yeah, and so I don't like that, that feeling of closing mid-range when it should close in the top quartile or so, or, even at the tippy top.
Right.
But this is what it's giving you. So to, kind of expect that out of this. So I think it looks classic. This is, in Brazil, and they're, other people are saying that they're like the Charles Schwab of Brazil is the nickname that someone else gave them, a different broker gave them. And you can see that there's a lot of volume there. It traded 2.5 million shares today. So it's not like a lot of the other IPOs that are out there that are kind of thin little goodies that with volume means there's institutions in there behind it. I looked, the T. Rowe is all over this one. A lot of their funds have a position. So this is a classic where you could have bought it with the downtrend in that IPO. And that's where we were first buying it.
On the date of January 17th. That's as it came through there. Yep.
And then as it went through the high of the IPO base,
right.
That's where you could either start buying it or you could add on to it. And that's what I was doing with this one. So far, so good. We'll see how it plays out. If it went under 38 and closed under there, I'd probably be, exiting it and looking to get it back into it. At a different setup.
Perfect. Let's go to the third and final stock, and this is Axon, ticker symbol AAXN, and it used to have another name, right, Mike?
Oh, a quiz.
You like that?
I like the quiz. Yeah, taser. I still think of it as taser. So this is the taser stun gun. And let's start off with the monthly chart on this one.
And their story now is not necessarily the stun gun, but the body cameras.
The body camera and
cameras,
the
and
service.
It's going to the cloud.
Yep.
And so another company that's kind of transitioned to the cloud, capturing all the data. They have law enforcement. They're kind of the one stop to really go for law enforcement. So they're capturing that whole market.
Yeah, exactly. So they're broadening out rather than being kind of a one-hit wonder like they were before. And like you said, having the service part of it where, kind of a cloud play, in a way, that's going to help with the revenue stream. Now, they got hit recently because there's some dispute with the government, and I don't want to get into that, and that is a risk with this one. So it did have that huge move back in 2003. Let's go to the daily real quick because I think we're pretty much out of time, but it formed that larger consolidation that was, it had three waves down in there, very powerful after the earnings, but it's been wild and, kind of wild and crazy or wide and loose. I'm trading it, but I'm not going to have a big position in it. One, because we have that over. Oh, you do?
Yes.
The great minds think alike.
I know. It's kind of scary.
Yeah.
Well, I don't know if it's great minds, but our minds think
well,
alike.
You're great, so I'm thinking like you. So, but anyway, so now we have this little double bottom that it just cleared today. And so that's where, I was buying it. I was in it before when the negative news came out. I sold it. Just was being Gumby and just circle back, man. You see what I did there? That was really cool. It's kind of like a Seinfeld episode. So you just have to be willing to sell it. When that news came out, it took a 7% loss or whatever. And then today, as it was breaking out, you just have to compartmentalize that loss and buy it back. If it closes under today's low, I'll probably be out of it.
60.
Yep. Yeah, exactly.
Okay, perfect. Well, there are three stocks that are worth considering for the watch list.
Sure.
Mike and I think we're on all three of these.
Yeah.
Which is So Mike, thanks so much for joining us on the third segment, and those precedents are definitely going to be helpful.
Thanks for putting up with me.
Yeah, as always. And thanks once again to Ian Formigle for joining us at the beginning of the show and educating us on what CrowdStreet is doing in the commercial real estate investment environment. So that's it for this week on Investing with IBD. Next week, we are going to have Scott Redler, Chief Strategic Officer of T3 Live, and he's a regular guest on CNBC, Bloomberg, Fox Business, and now you could put Investing with IBD podcast on there too, like that. So that's it. I'm Arusha Pierce, and thanks for listening.